Welcome to the channel. Today, we're diving deep into one of the most controversial, difficult, yet incredibly fascinating aspects of the financial markets: short selling. To buy a share of stock? That's a hopeful act, a belief in growth, in prosperity. The man who buys long is a partner in creation, a believer in the future. The public understands and applauds this man. But to sell short? To bet on a decline? That is an act seen as unnatural, cynical, and almost predatory. You are seen as a critic, a bear, a person who profits from ruin. This is a business the public will never fully understand or forgive. However, for a master speculator, a person who seeks to profit from every major market swing, being on the short side is just as important as being on the long side. The market moves in two directions, and to ignore the great downward movements is to ignore fully half of the magnificent opportunities that the game presents. To understand the psychology of the short sale, one must first confront the brutal mathematics that govern it. This is the fundamental difference between the long and the short side, and it's the source of the immense psychological pressure that crushes the ordinary man. Part 1. The brutal mathematics of short selling. When you buy a stock, go long, your risk is by its very nature limited. You may lose your entire investment, but you cannot lose more than that. If you buy a stock at $10, the absolute maximum you can lose is $10 per share. The price cannot go below zero. The short seller, however, faces a different and far more menacing reality. His risk is, in theory, unlimited. You sell a stock short at $10, hoping it will go down. But there is no theoretical limit to how high that stock can go. It can go to $20, $50, $100, or even higher. With every tick upward, the short seller's loss deepens. While the long's loss is a finite number, the short's loss is an ever-expanding, terrifying void. This asymmetry of risk is the first and most important reason why the short side is a game only for the true professional trader, the man of iron nerve. This mathematical reality creates a psychological pressure that is unlike anything else on Wall Street. The speculator who is long a losing stock is often sustained by the gentle and seductive poison of hope. The speculator who is short a rising stock is subjected to the raw, visceral, and immediate emotion of fear. Part 2. The psychology of short selling, the battle with fear and pressure. Every headline announcing good news for the company is a blow to his solar plexus. He is at war not just with the ticker tape but with the entire optimistic consensus of the world. He is the one man standing in the path of a stampeding herd. This pressure is most acute during the phenomenon known as a short squeeze. This is a speculator's nightmare made manifest. It occurs when a heavily shorted stock begins to rise, and the shorts are forced to buy back their shares to cover their positions. But this very act of buying only adds fuel to the fire, creating a vicious, explosive upward spiral. Beyond the risk of a squeeze, there is the critical importance of timing. On the long side, you can afford to be early. On the short side, however, to be right too soon is often indistinguishable from being wrong. A speculator can correctly diagnose a bubble, but if he shorts too early, he will be wiped out long before his prediction comes true. The market can remain irrational far longer than a short seller can remain solvent. The master of the short side must therefore be a master of timing. He must wait with the patience of a saint for the market itself to give the final, definitive signal that the top is in. Part 3. Why short sell? Magnificent profits and the transfer of wealth. With all these risks, why do it? Because the rewards, when one is right, are faster, more violent, and more magnificent than anything on the bull side of the market. A bull market takes months, sometimes years, to climb its wall of worry. But a bear market, a market in a state of panic, can collapse in a matter of weeks or even days. Why? Because fear is a far more powerful and faster motivator than greed. Fearful face. The profits on the short side are compressed into a much shorter timeframe. This is the great prize, the opportunity to profit from the sudden, catastrophic force of gravity. This is why Livermore, the great bear, was so drawn to this side of the market. He knew that to be a successful short seller, a man must first be a ruthless realist. He must see the world as it is, not as he wishes it to be. He must be able to diagnose the signs of a topping market, the wild public speculation, the faltering of the old leaders, the churning on high volume, even when the world is proclaiming a new era of permanent prosperity. He must have the courage to stand alone, to sell short when everyone else is buying, to be the one sane man in a world gone mad. Part 4. Deconstructing Livermore's Trading Edge. Livermore's genius wasn't just in what he saw, but how he acted on it. His triumphs in 1907 and 1929 weren't lucky guesses. They were the result of a disciplined, repeatable strategy. Let's move beyond theory and break down the exact steps he took to enter one of the greatest trades in history, shorting the 1929 market crash. This is his blueprint. Livermore's 5-step blueprint for entering a short position. We can distill his method into a powerful 5-step blueprint. This is the core of his short-selling edge. Step 1. Form the macro thesis, reading the market's heel. First, Livermore didn't look at a single stock, he diagnosed the entire market. In the late 1920s, he saw the signs of a great top forming. He identified a profound sickness, wild public speculation, and the abandonment of conservative values in favor of a delusional belief in a new era. Your takeaway: before you short a stock, form a bearish thesis on the broader market. Is the optimism irrational? You must first see the storm clouds gathering. Step 2. Identify the weakest links, the perfect targets. Once he was bearish on the market, he hunted for the weakest animals in the herd. He looked for the faltering leaders that were churning on massive volume, a sure sign of distribution, and low-quality stocks fueled by pure speculation. Your takeaway: don't short the strongest stock. Look for former leaders that are showing clear signs of weakness. These are your prime targets. Step 3. Wait for market confirmation, the patience game. This is what separates pros from amateurs. Even with his thesis and his targets, he did not act. He waited for the market itself to prove him right. He needed the tape to give him the final unmistakable signal that the line of least resistance had turned downwards. Your takeaway: your opinion means nothing until the market validates it. You must have the discipline to wait for price action to confirm your bearish view. Step 4. The exploratory probe, testing the waters. This is his genius entry tactic. He didn't jump in with his full position. Instead, he began to send out small, exploratory short positions. The purpose was to test his timing with minimal risk. He was asking the market, "Are you as weak as I think you are?" The market's answer was his trigger. When these probes showed a quick and decisive profit, he knew his timing was correct. Your takeaway: don't go all in at once. Enter a small, feeler position first. If it's immediately profitable, it's a strong sign your timing is right. If not, you can exit with a tiny loss. Step 5. Pressing the bet, building the campaign. Only after his probes were successful did Livermore commit fully. He then began to build his massive short line. He did this by pyramiding, adding to his winning position as the market began its descent. He scaled into his winning trade, increasing his size as his conviction was proven right by the falling price. Your takeaway: your biggest positions should come from trades that have already proven you right. Add to your winners, don't average into your losers. This is how you achieve spectacular profits. Part 5. How to build your own trading edge. From Livermore's blueprint, we can create a modern framework for our own trading edge. Step 1. Master the mathematics of risk. This is your foundation. Your stop loss is absolute and non-negotiable. Your position sizing must be cautious, especially on your initial probes. Step 2. Master your psychology. Embody Livermore's patience and discipline. Have the courage to wait for confirmation and the humility to accept when your probes fail. Banish hope and fear. Operate like a scientist. Step 3. Develop your big picture analysis, your macro thesis. How will you determine if the market is sick? This could involve analyzing market breadth, sentiment indicators, or macroeconomic data. Step 4. Refine your tactical entry, your probes. Define what a successful probe looks like for you. What is your precise entry signal? What constitutes a quick and decisive profit that tells you to add more? Step 5. Define your position management rules, your campaign. How will you pyramid? At what levels will you add to a winning short? Having predefined rules for scaling in and taking profits is critical. Part 6. Summary of the psychology for a high success rate. To recap, achieving a high success rate in short selling requires a superior psychology. Ruthless realism. See the market as it is, not as you wish it to be. Ironclad discipline. Adhere absolutely to your trading plan and stop loss. Infinite patience. Wait for clear market signals. The market can stay irrational longer than you can stay solvent. Supreme emotional control. Banish false hope and conquer primal fear. Disciplined contrarian thinking. Don't be different just to be different. Be different because the data tells you to be. Humility. Be ready to admit mistakes and cut losses small. The line between courageous persistence and foolish stubbornness is a fine one. The art of the short sale, in the right hands, can make a man a legend. But it is a tool of such immense and dangerous power that it will utterly destroy the man who is not its complete and total master. It will exploit his every emotional weakness, his fear, his hope, his ego, with a swift and terrible finality. The speculator who would engage in this most difficult of all market operations must first have achieved a state of complete and total mastery over himself. Please like, share, and subscribe so you don't miss our next deep dive into the market and trading psychology. See you in the next video.